Money on my mind, gotta hustle and grind. Financial literacy always on my mind. I'm stacking knowledge, no time to waste. You gotta invest smart, gotta keep up the pace. I'm reading books, learning all the tricks, studying the market, making calculated picks.
What's good, everybody? It's your boy Reckless Ray Dinero, and we are back at it again with another episode of Bag Talk. Today, we are going to be talking about one of my favorite single stock positions that I've been holding for a little while now. I kind of veered off the single stocks for a little bit there, brought a couple back in, made a couple of plays. One went really well, one stopped out, and we're working on getting back in. And the one that stayed was actually kind of my low-key sleeper, TSYY. And today we're going to break down, I'm going to give an explanation on how that stock works, how they make money, and we're going to talk about how I'm utilizing it as kind of a magic bullet, if you would, for my portfolio. It's the supercharge. It's kind of the nitrous for my portfolio. And we're going to jump into that. Before we get to it, let's make sure that we've hit the like on the way in, especially if you've been here more than 2 times. Definitely make sure to hit that subscribe button. While doing that, hit that bell notification to make sure all notifications are on. I promise not to flood your feed, but you will be notified when these premieres are dropping live first thing in the morning on your commute to work, getting your mind right first thing in the morning. Last but not least, free way to support the channel is to share the video and get me out into the algorithm. So that way I can be a bigger part of the conversation. Somebody who has the context of working their way out, still in the mud with you, might be a little bit further ahead, but definitely not out of the pits yet. Counting down these 22 months until we get to that point to where we are at fully work optional, which we will be hitting work optional in 2026 per the metrics. But 22 months is my track where I should be able to, should I want to, be able to leave work and still have the exact same lifestyle I have now, with the cushion of the volatility of the market, because nothing in high yield is consistent. That's the one thing that we've learned over the past year. Like it's feast or famine. But once this debt is paid off, the consumer debt piece, and actually the loan that we took that we're both funding the portfolio, doing some remodeling around the house, and purchased a vehicle. Once that is clear, and we are free and clear, because that's one of my metrics for being able to even consider leaving the workforce, is having all the debt gone. I don't want to be worried about that while also trying to manage the portfolio. Like, that's just a variable that I don't want to have to deal with. Let's go ahead and bring this up to the screen, though. So today we are talking about TSYY. What is TSYY? Well, I've got it pulled up for you. The Granite Shares Yield Boost TSLA, Tesla, for those of you who aren't in the know, ETF. First and foremost, why is it the nitrous for my portfolio? Because it has the highest distribution rate. It's at 142% right now. As of October 24th, they update on the fly. I do like the Yield Boost Suite. I am considering making my own Yield Boost top performers, like maybe the top 3, and kind of doing a little bit of what Roundhill does with their portfolios. It's been something that I've been mulling around. After I'll be working towards that. As of right now, the TSYY position is the only one that I'm holding that's a single payer. I had the XBTY, and I was stopped out on that because Bitcoin got beat up in the markets, and we've been kind of waiting to get back into position on that, because we had to sell part of that off, condense it down to TSYY and Ulti. And as we're funneling this money back into the portfolio from the loan, all of our leftover scraps from the loan, we are what I'm looking at is getting the portfolio set really to be able to cover that loan before I start doing anything else. Now, after we get back to normality, when I'm getting about $1,500 a month to throw into the markets, I am going to probably start maybe looking at another single player. Granite Shares is kind of my favorite. I'm not going to lie. They've got some really good offerings. I also have to bulk up that position of wpay. So am I going to be able to add in another single payer? I don't know, because I got a whole lot of wpay that I want to buy. And, we've got a little bit more TSYY to buy. Things are moving along and I'm happy with it, but I'm really loving my TSYY position. I mean, I like it so much that I'm buying it, even though I'm in a total return. This is the best performer that I've got right now out of everything, including my diversified stocks, which is why I say, diversification is stepping back the volatility. Now with Ulti, different conversation, but TSYY has a firm place in my heart because it's been performing lately and it's given me a lot of cushion to ride some volatility. It's currently sitting at $7.74 as of this recording, which is not going to be when you're seeing it, but like as of this recording, it's at $7.74. We did a drop down to a little bit sub 70s, went ahead and did some buys because we were actually at a declined NAV that shows in my portfolio. And, I like it. What does the product do? The overview of it from Granite Shares themselves is the Granite Shares Yield Boost TSLA ETF, TSYY, is designed to generate income through option strategies, primarily by selling put options on leveraged ETFs that track the 2x long Tesla daily ETF. Now, with that said, I'm going to go ahead and break down this core strategy. Okay, so we're going to go with, I'm going to break this down into some simpler terms. So TSYY uses a put spread option approach on the leveraged Tesla ETF, which obviously it said in the description. But here, this is how that actually breaks down. So they're selling puts for income. The ETF sells near the money put options on the 2x leveraged Tesla ETF. A put option gives the buyer the right to sell ETF shares at a set strike price. By selling these, TSYY collects upfront premiums from buyers. So they get paid when they sell those near the money put options. They sell those options off, they collect the premium. Like getting paid to take on a potential obligation. If Tesla stays stable or rises, so the put options expire worthless, TSYY keeps the full premium as income, which funds its high yield distributions, often over 100% annualized, paid weekly. So that's the main way that they make money. So they're selling put options that they're banking on getting so far out of the money that they expire worthless. Then you just keep the money that you generated, that they already paid you for the premium for the option, for you to buy at the set strike price. And then if the price stays stable or goes up, they get paid. That's the way this works. You want Tesla staying flat or going up, because then they get paid and they get to keep that money, and that's just income. The second way they generate money, which is actually more of a hedge, is buying protective puts for safety. They do this to avoid unlimited loss if Tesla drops sharply. They buy cheaper out of the money puts. This is how they do this. They buy the cheaper out of the money put options on the same leveraged ETF, which acts as insurance. So if the price dumps, then those puts that they bought, the protective puts, become worth money. So those can be sold off to keep the losses from being unlimited. You're still going to see losses if the price goes down. but they're not going to be as bad as if they didn't have protective puts. The third way that they make money is with the leveraged exposure. TSYY holds or synthetically tracks the 2x Tesla ETF for amplified sensitivity to Tesla's price movement. Now, most people would think, oh, well, if it goes up, you go up 2x. Well, that's not true. You have a capped upside. Gains are limited because the strategy doesn't fully participate in big Tesla rallies. So you're not going to get all of that because this generates money based on Tesla staying flat or going up slowly. Sharp spikes up do not benefit this aside from the income. You're not going to see the NAV climb significantly. It'll climb up to the capped upside. And that's as far as you can go. So there are other ETFs, if you're wanting that NAV growth as well, that probably distribute a little bit less. And actually, for reference, I actually want to go look at this because I know where one of those is. Let's go here. Yep, there we go. So the counterpart to this that would participate in the full upside would be Roundhill's TSLW. That gets uncapped upside, but what do you get in this on the flip side of that? I'm pretty sure, actually, let me go ahead and check that too. TSLW. Okay, so the base rate of this fund is way higher. It's $38.08. Distribution is 113.56, which actually is not bad, but you don't get the full upside. And you know what? This might have this did just make it onto my watch list. And I'll tell you why. It's because this way, if you do both, you can do both. I don't believe in a either or. You don't just have to have one fund, especially for the strategies, the style of high yield that I run. I'm a both type of guy because if Tesla has a run, I want that. But I also like the stability because that way you're covered on everything but the downside, obviously. You could also add in a Tesla inverse fund and then you're covered every direction, but that seems a bit excessive. But having TSLW and TSYY, 100%, because TSYY currently, the distribution rate, it just pays more. The caveat is if Tesla spikes, you're not collecting all that upside. You're not going to get all the upside. So, there's definitely a place for that. And, this is the trade-off that you get is you get the eye-popping yields. We're over 140%. That's the upside. The con, high volatility. This is not a set and forget position. I am managing this position all the time. Like, granted, from when I started, I have a cushion. I'm sitting at a total gain right now of approaching 10%, which, considering I've been getting paid this whole time also, and it's going and paying off debt and doing other stuff and paying for a car and getting ready to start paying for some repairs and upgrades. Those are all things that are freaking awesome. The way that I'm looking at it from this point, the cons really aren't even a factor right now because I'm willing to clip the position if it gets to a 10% total loss. Like if we flip the other direction and we're in a prolonged bear market and I got to start clipping stuff or consolidating down into some safer plays such as wpay that gets the collection of everything, or whatever else becomes available, because when the market goes down, that's when a lot of these funds spin up, because that's a great time because you can catch that upswing and your fund looks amazing. But I manage my portfolio like I'm looking at it. I look at it at least once a day, at least a couple of times a day. And I also am making adjustments and moves weekly, if not on my dividend on my dividend paydays, which is, as it sits right now, 4 days a week. So I got 4 days a week that I'm in the market, like actually paying attention, and I look at it every day around lunchtime. So just to see what's going on, see if I need to make a move. The obvious thing to say is high volatility. It's a single payer. It's a single asset stock. We learned our lesson with msty. That can go both ways. msty, we got out at 20%. We were still up 20% total return on that position when I decided to pull off of that position because the distributions and the NAV took hits. And I could deal with the NAV hit. The distribution hit I was not willing to take that because that was going to set me up for failure moving forward to like ride that to zero. Like those of you who are still riding it at 12, much respect. That's going to be a long climb back up to the 40s. It's going to be a long climb back up to 15. It's going to be a long climb back up to 20. Which the NAV I don't care about because obviously TSYY, why did we get it? Because it's less, it was less, well, you were getting more for a low cost. It's a sub $10 ETF, which I think is great for hypercharging your portfolio. It works for me. You're taking a lot of risk, but also you can produce more income. I mean, I'm getting paid more with TSYY than I am with Ulti, and looking at the portfolio, the position sizes are noticeably different. I have almost $24,000 in Ulti. I have 12 in TSYY, and TSYY eats Ulti's lunch every week. Every week I get more money out of it. So you need less money in it, which is awesome. Like you get more bang for your buck, but it's also higher risk. I have been fortunate in the timing of getting in position on it. And for reference, as of this recording, the buys from today haven't registered, but I bought about $1,300 more worth of TSYY shares, but my cost average is $8.01. I've been buying TSYY. I bought higher than where we're at now. So it took like a 26% hit or 26-cent hit in the NAV off the surface, but I've been getting paid this whole time. So that actually covers, and it's the reason that I'm in a total profit of exactly 8.8%. So I'm going to continue buying. Like there's no reason to not buy. I don't think Tesla's going away. We're having a hiccup, but like also I'm good. I'm actually in total profit good on all my positions again. And honestly, a week ago when I was recording, like going towards the end of October, it was looking ugly. Like it was looking like we were going to get stopped out of some more positions potentially. And like now everything is, the market turned. All of my stuff turned, and stuff's climbing its way back up. That's how this works. That's the reason you have to manage it. That's part of the reason it's not necessarily set and forget unless you're in something that's well diversified. So like a wpay, I can set and forget wpay. Blocks, because I understand crypto, I'm willing to set and forget blocks. I'll put that on drip indefinitely and not look at it for a while, and then come back on one of the market upturns, and like you've been collecting blocks the whole time, I would do that. Tesla, while I like Tesla, before I would set and forget a single stock payer, I would get up to enough, and this is what I plan to do with all of my single stock payers as soon as my consumer debt's paid off. My single stock payers will be utilized to buy shares of the stock that is the underlying. I would prefer to do that than drip indefinitely. I would prefer to get to a point to where I can buy a share a week, because these pay weekly, and get 4 shares of the underlying a month, and then have that, so that way if things turn around, I've got somewhere to go. And then as the stock rises, then you rise that position to get it back in alignment to be able to buy 1 share a week. That's kind of my goal for my single stock payers. Am I going to bring back in a MicroStrategy single stock payer? Yes, I am definitely going to do that. At what point? I don't know. Which one? I don't know, because honestly, I don't have a bad taste on with msty in my mouth, because I was at 20% total profit when I got out. So I'm good on that position. It just wasn't working to be in this portfolio because the percentage was crashing everything else, and it was the only thing I was holding. Now I've got 3 positions that are payers in here: TSYY, Ulti, and wpay. All payers, all doing their job, all sitting at percentages I can deal with. wpay is actually going to be taking up the mantle of my primary position as soon as we cross that threshold of $40,000 projected over the next 12 months. What that means is I've already stopped buying into additional shares of Ulti. We're going to be sitting at that about 4,000 shares, letting it ride. What we're doing is we're going to keep pumping money into wpay and TSYY, which predominantly we're doing 70-30. 70% goes to TSYY every infusion, and 30% goes to wpay. Obviously, 10% after the 10% that we cut off the top to go into blocks, because we're trying to keep it at roughly 10% of the portfolio. And if we looking at our dashboard, blocks is currently at 8.78% of the portfolio, which is nice. We're getting there. wpay is only at 7.4%. So that wpay percentage is going to just keep growing. We're going to keep Ulti riding because it's paying well and still giving us our pay. And TSYY also paying well. Our passive income percentage as it sits right now, well, it's going to be, and see, this is going to be a little bit different after it updates, but we're still sitting at right at 100%, 99.78. And the reason we buy that TSYY is it's adding that boost. And then we're going to be looking at TSLW, because my TSYY position, I am enjoying that position, even with the dips. But now I could also start putting TSLW in position as well, if that's going to be 100% coming up behind this as a single payer and double up on Tesla. I do like Tesla. I do want Tesla shares. So as we work towards getting that into the portfolio, like, something to think on. Now, again, this is a managed position. This is not a position that's set and forget. This isn't drip indefinitely. I did drip this position until I got to $250 a week, because that's for my weekly payers that I'm using for bills and whatnot and managing the portfolio. That's my target, is $250 a week. Once it starts kicking off 250, now it's released to the hounds. Like, when it comes out, we get a share of blocks generally, and the rest of it, we have a certain portion of it that comes out that goes towards the Cash App flywheel, which we're still using to chunk at stuff. We're currently using it to chop at the to ensure that we have our pool for our loan payment. So every month we're going to probably have like one of those Cash App payments set aside, the majority of it, to make sure that we're covered on our loan. Because like, I just have the money sitting in the bank and then I move it over, payment date, call it a day. But that Cash App flywheel is still going. And as we grow this income, hopefully what we'll end up doing is being able to do it every 2 weeks. And then we'll be able to just shoot that out swiftly every 2 weeks and then pay stuff down faster. It just chunks it down faster. And allows me to move things that are higher interest into lower interest. And if we're hitting it every 2 weeks, that means we're going to be getting at least $2,000 a month up front. So that'll be $1,000 for the deal. And then honestly, if I can get this into like the every 2 week range, then I could actually just use the cash out flywheel to fund the loan. That could be interesting also. So yeah, we're working towards making some stuff happen, and I am very excited about it. But TSYY is a staple in my portfolio at this juncture. It's 30.7% and climbing because we're still buying. We've still got a few big buys, and the 30% isn't accounting for what we bought at the day of this recording. So normally I do a recording on Monday. I do if I have loan money that's going in, I try to have it land Monday or Tuesday. For the dollar cost averaging of the $10,000 that we got in the personal loan that was extra, it was like a little over 10,000. I think it was like 14,000, something like that. And as we're moving that money into position, I didn't want to put it all in at once, which thank goodness I didn't, because we had some market volatility. So I've been disseminating that in over a few weeks. So we're investing about 2,000 a week, normally on Monday. This Monday, I was actually considered, since the market was down before I'd corrected myself, I was going to do 1,000 Monday and 1,000 Friday, which honestly for dollar cost averaging would probably work a little bit better. But getting it all in there on Monday and just letting the week ride, because like last week, got to the end of the week, was a little bit rocky, had a nice little bounce, rebound over the weekend, came in today, still got some deals. Because otherwise I'm just going to be putting money in all the time. So if it happens that there's some sort of black swan event and we have like over a 5% or a 5% swing, I would take a 5% swing too. I would consider adding in extra, but following the schedule and just making sure I'm putting money in on Mondays has been working. So that's also the most responsible I've been with a large amount of money, as far as dollar cost averaging goes, because I do get excited and I do want to buy it all at one time, not knowing what's going to happen in the future, because it just makes me feel better. And, the opportunity cost for dollar cost averaging with high yield is income. I don't care about what the NAV does, but if I can get my money machine on a discount, I will do that, because the TSYY position's been holding steady. They've been doing a really good job with their distribution. Like as we scroll down here, it's been sitting around 22% or 22 cents. Oh, they have some 30s. May 23rd, they had hold on. That was when they were doing monthly. So they switched from monthly to weekly, which makes sense. I would prefer weekly anyway. So we are sitting at around rock bottom at 20 cents. So 2022, when they switched initially from monthly to weekly, it was 30 cents was when they started. They had a couple of weeks at 30. Then it's kind of slowly matriculated down, and then it's bounced, because this is going to be based on how those puts are working. But it's sitting around 20 cents. And like my basis is, I think I made my position based on 20 cents, because I think that was the lowest I'd seen. So I based mine on 20 cents. So we're sitting at the basis. I mean, also, since we've grown the position, I am getting over the 250 a week. So there's also that. Like, I mean, I'm not complaining. Do I think it's indefinitely gonna go down? I mean, as long as Tesla stays flat or goes up slowly, we're good. And if they can keep 20 cents roundabouts there, I'm gonna keep riding it out. Like, this is gonna be my go-to for now, and I do want to add some TSLW to the portfolio, so that's going on my watch list also, because that's over 100% as well. Also kind of looking at, I mean, I don't know, so the Granite share strategy, I do like Tesla, and I want both sides of that. So I think moving forward, if I do a position, I honestly think I'll probably, to keep it all weekly, be doubling up, and I'll be doing a Granite shares with a counterpart of a roundhill counterpart, so that way I can catch the upside, and then jockey them as needed. Like if we're sitting flat, like whatever's on sale. But with the roundhill, generally speaking, at least the last time I was using it, when I was getting up to about 30%, because the roundhill ones, there's uncapped upside. So like those do spike up. So like that would be something where you didn't capture the upside. It goes up 30%. You roll that into TSYY and then use the shares from TSYY to buy more. I think that's how that would work. So you'd have TSLW, and that's going to be your uncapped upside, but you're also getting paid weekly. The goal of this is to get your positions for your single payers to where they can buy shares of the underlying. So we're trying to get a Tesla shares every week. But you're going to have spikes on the TSLW. And if you have a run up and you get that spike, you consolidate the TSLW, you sell that off, and then actually you would sell that off and then use those funds to also buy the underlying. And then as those prices level out, this would be the kicker. So then you would start, as you sold that position off, however many shares you sold, you would buy that position back with the TSYY as you get paid weekly to build it back up. Yeah, I like this. So yeah, that's what I'm going to do moving forward for my single payers. I'm going to double up. I'm going to do TSYY and TSLW. So I got to add that to the list because that's going to be the next thing I add in this portfolio. And then I've got to start hunting for some micro strategy. I'll probably do Granite shares and Roundhill. I like that combo. This is a magic bullet. And this has been another episode. I'm going to actually finish that off there. So hopefully you guys got some, good information. Hopefully you understand Granite shares, TSYY a little bit better. You understand, at least the logic behind why it's in my portfolio. It is a magic bullet for me because it's adding that extra to keep me up over 80 to 100% right now. When we start dialing back, we're going to be bringing in wpay. Obviously that's part of the dial back, but TSLW will also be part of the dial back because it's at 113%, not 140. Little easier rolling, little less leverage, little tasteful leverage. 1.2 versus 2 is a big difference actually when you start looking at dips, and the uncapped upside. So that way we can fully participate in those run-ups. There's a million different ways to skin this high yield cat. And I think it's going to be interesting looking at me as the income gets to certain levels and I start having to dial back. Is going to be interesting because I'm not good at that part of it. Because with the exception of like, I'm just going to buy a bunch of Bitcoin, like that's an easy one for me too. But building out these portfolios and actually getting the metrics where it's like, I should bring in something that's got a little bit less volatility, like something that's a little bit safer. Those are words that I never say. But generally it's because I get all the volatility, all the upside, and all the safety from Bitcoin because like that's the standard for me and the way that I deal with finances. So, having to deal with a TradFi portfolio and this type of income versus yield farming, because yield farming is just shooting stars. It's great and then it's over. And so I'm trying not to do that with my high yield portfolio, but I can see the allure and how people who are constantly chasing the upper echelons of yield end up in positions where they end up upside down and then they blow their portfolios up. And we're not trying to be those people because I've had yields well over 142%. So This is a little bit slower rolling, and I'm trying to put the skills that I've picked up in DeFi, the losses that I've taken, the harrowing over the course of a couple of weeks, losing $60,000, which is like somebody's salary. I mean, sometimes it's my salary. So, and applying them into this slower moving space where you don't wake up and, 20 grand's gone. So we're getting there. And as we move forward, we keep documenting. Hopefully you guys are learning from my mistakes, my pain, because we're working it out. We got 12 months in. I'm starting to kind of feel sort of like I got my feet under me with this, because this is just so different from the crypto space, from what I'm used to. And while it is slower in the sense that you're not having havoc wreaked while you're sleeping, it's also it also requires attention, because it is still, like, obviously there's a winner and a loser on each side of every trade, and there's people out here that are pretty good at taking our money. So you do have to pay attention to what you're doing, even at a slower pace, because you could end up in a spot where you don't want to be. And we're not trying to do that, like, because at that point it's like you could have just went and bought Bitcoin, bro. Like, you already knew what was going to win, which I'm still buying. But we gotta have that a little gamification, a little speeding me out of the workforce, because I can't buy and spend Bitcoin yet. Unfortunately, I don't have a big enough cache of Bitcoin to where that's an option. But we're gonna get there. So till the next time, people, this has been another great bag talk. Don't forget to hit the like, share, and subscribe. All free ways to support and help grow the platform. Till the next time, it's your boy Reckless Ray Dinero, and I'm out. Peace.
Money on my mind, yeah. Focus, got no time for games, nah. I don't play, man, I'm all about that financial literacy. Investing in my future, building generational wealth. Dollar bills, they be calling my name, but I ain't chasing fame, I'm chasing change. Learn the game, now I'm playing it smart. Putting my money to work, it's an art. I'm stacking paper, building my own empire. No more living check to check, I'm getting higher. Investing in stocks, real estate, and more. Gotta secure the bag, that's what I came for.